Should you buy stocks now? Is it a good time to buy stocks now? In this video, I'll be sharing with you my view and analysis of whether I believe it's now a good time to buy stocks. And to give you a little context, when I say buy stocks, I am meaning investing in stocks and not trading in stocks. In this video, I'll be taking a look at the question of whether is it a good time to invest in stocks right now. Okay, let's jump right in. There are a couple of articles out there mentioning that now might be a potentially good time to invest in stocks. This is one of the articles. In this article, they mentioned that Warren Buffett is buying stocks again. One of the stocks that Warren Buffett has recently purchased is Bank of America. And the article mentioned that Warren Buffett's reappearance in the stock market suggests that value investors might still have a chance to buy quality shares that missed the rally. But on the other hand, there are articles out there mentioning that now might not be a potentially good time to invest in stocks. This article by CNBC mentions that investors might be warming to the stock market. And because the stock market has rebounded in the past couple of months, they are more optimistic about the stock market. But this article is not so optimistic. So the big question is this: is now a good time to invest in stocks, or is it not a good time right now? Before I invest in the stock market or invest in stocks, there are many things that I take a look at. But one of the most important things that I take a look at is the risk to reward ratio. When I'm taking a look at the risk to reward ratio, I ask myself two questions. So the first question is the potential upside more than the potential downside? And the second question that I ask myself is the risk to reward ratio good? The first question that I take a look at is the potential upside versus the potential downside. I'll ask myself, how much can I potentially make versus how much I can potentially lose? In the stock market, no one can predict exactly where prices are going to move. So with that said, no one can predict exactly how much he or she can make, nor how much he or she can lose. But taking a look at certain figures and data, we can have a rough estimate of how much we can potentially make versus how much we can potentially lose. And I'll be going through some of these figures and data that I take a look at later on in the video. Moving on to the second question is the risk to reward ratio good? So the question I ask myself is, are the rewards worth the risk that I'm taking? If the rewards outweigh the risk by a certain threshold, then it makes financial sense to invest in that stock. To give you greater clarity on the risk to reward ratio, let's take a look at an example. Let's say that we are taking part in a coin flip. And in this game, we win $1 for every heads and we lose $1 for every tails. What will the risk to reward ratio be for this coin flip game? The risk to reward will be 1:1. And why is that so? Because for every tails, we lose $1. And for every heads, we win $1. So the risk to reward ratio is 1:1. So let's say we flip this coin 100 times. What do you think is the expected payout for this game? Will you lose money? Will you break even? Or will you win money? We know that the probability of flipping a heads is 50% and the probability of flipping a tails is 50% in a two-sided coin. By flipping the coin 100 times, the number of heads to the number of tails would be around 50 to 50. Let's multiply it by 50 and multiply it by 50 for the rewards too. So we will lose $50 because 1 multiplied by 50, and we'll win also $50 because 1 multiplied by 50. So at the end of 100 flips, we would break even because 50 minus 50 will give us $0. However, playing the same game using this same exact coin, we increase the risk to reward ratio to 1:2. So the risk to reward ratio for this game would be 1:2. And using the same coin, the same two-sided coin, if we flip the coin a large number of times, say 100 times, what will be the expected profit from playing this game? We will lose approximately $50, right? Because 1 multiplied by 50 would means we lose around $50. And what is the rewards? Our rewards will be 2 multiplied by 50. So with 2 multiplied by 50, we will make $100. So the expected profit from playing the same game but with a higher risk to reward ratio means that playing this game we can potentially make $50 because $100 minus $50 gives us $50 profit. Can you see how even though the probability of being right and the probability of being wrong remains the same, we can increase our profitability by increasing our risk to reward ratio? And the same thing is true when we are investing in the stock market and investing in stocks. Before I invest in the US stock market and in US stocks, the first thing that I take a look at is the S&P 500. The S&P 500 tracks the 500 large companies in the US, and I believe that it gives a good idea of how the overall US stock market is performing. If you take a look at the price chart, prices close at 320.88 as of the filming of this video. At this price level of 320.88, is it a good time to invest in stocks now? To have a better perspective of whether now is a good time to invest in stocks, we go back to the period where the pandemic first hit and stock prices declined significantly. This period was during the February and March period. So if you take a look at this price chart here, from peak to trough, or from the high to the low, prices declined by 35.67%. Back when prices declined by 35.67%, would that be a good time to invest and buy stocks? Let's take a look at this chart which shows the previous bull and bear market since 1942. So the technical definition for a bull market is when prices have increased by 20% or more, and the technical definition for a bear market is when prices have declined 20% or more. This chart shows the previous bull and bear markets all the way since 1942. The average bear market or the average decline in prices in the bear market was 30.57%. So if we take a look at the previous bear market, so here was 28%, here was 20%, here was 21%, here was 27%, 22%, 36%, 48%, 27%, 33%, 36%, and 33%. So the average bear market was 30.57%. The worst bear market was during the 1973 and 1974 period where prices declined by 48.2%. I believe that this chart hasn't taken into consideration the 2008 and 2009 financial crisis where prices declined by around 50%. But we'll just take the figure provided in this chart here. So the worst decline was 48.2%. Now that we know the average bear market decline is 30.57% and the worst bear market decline is 48.2%, let's take a look at the charts again. During this bear market, which was caused by the pandemic, prices declined by 35.67%. We know that this bear market was slightly higher than the average bear market decline. But this bear market decline is not the worst because we know that the worst bear market decline since 1942 was around 48.2%. When prices were at the bottom here and when prices have declined by 35.67% from peak to trough, would that time be a good time to invest in stocks? What do you think is the potential downside at that point in time? The potential downside at that point in time would be 13%. And why 13% decline? Because we know that the worst bear market decline was 48.2% since 1942. So based on the historical figure, we know that the potential downside would be around 13%. Can prices decline by more than 48.2% in a bear market? Possibly, but we know from historical data that is unlikely. At a point in time where prices have declined from peak to trough by 35.67%, the potential downside at that point in time was around 13 to 14%. Now that we know the potential downside in the time where prices bottom, what is the potential upside during the same period of time? Going back to the same chart, we see that prices increased by an average of 149% in an average bull market run. Some of the bull market run include 157%, 23%, 267%, 86%, 79%, 48%, 73%, 125%, 228%, 582%, 21%, and 99%. And the average of all this was 149.53%. The lowest percentage change in a bull market run was the period in 2001 and 2002, where the percentage change in a bull market run was only 21.4%. Since 1942, that was the worst performing bull market run. So at the point in time where prices bottomed out at this level over here, the potential upside was 21.4%. And we are using the most conservative figure based on the historical data. So we are using very conservative estimates for the upside and very aggressive estimates for the downside. The potential upside would be around 21% and the potential downside would be around 13%. The risk to reward ratio is around 1:2. At that point in time when the market bottom, is it a good time to invest in stocks? Yes, it would be, right? Because even though we are using very conservative estimates for the potential upside and very aggressive estimates for the potential downside, the risk to reward ratio is still good. No matter the time period and where we are currently in the stock market, you can always use this risk to reward ratio to help you make better investing decisions in the stock market. Okay, so fast forward to today. we are currently at this point over here where prices close at 320.88. From the time where prices bottom out to the high of prices a couple of trading sessions ago, prices have increased by around 50%. So is it still a good time to invest and buy stocks now? Based on the historical data, the risk to reward ratio is still relatively good right now. Going back to the same chart, we take a look at the average bull market. So in an average bull market, we see prices increase by around 150%. And in an average bear market, we see prices declining by 30%. So in this bull market, we are already up by around 50%. Based on historical data, we have a potential upside of around 100% more. However, if prices suddenly reverse back into a bear market, we know that based on historical data, our potential downside is around 30%. Right now, based on historical data, the risk to reward ratio is around 1:3. And that is still a relatively good risk to reward ratio. If you are deciding to invest in stocks now, based on the S&P 500 and its risk to reward ratio, which is based on historical data, the risk to reward ratio is still relatively good. This is the price chart for the S&P 500 going all the way back to around 1940s to 1950s. Say you decide to invest at this point over here. You will see that in the long run, prices increase, right? From here to all the way here. In the long run, prices increase and you make money. If you're a buy, close your eye and hold investor, this strategy works because as you can see that over the years, the stock price of the S&P 500 did increase over time. But unlike the buy and hold investors, I'm not okay seeing my investments and my capital decline significantly in the short run. If you take a look at the same price chart, let's say the buy and hold investor bought it at here. And we know that over time, they make money because you can see that from here to here, prices increase and those buy and hold investors do make money. But the thing is, if those buy and hold investors bought it at this point here, you'll see that in the short run, prices decline quite significantly over here. And I know that I'm not okay with this kind of significant drop in my capital and investment. I'll very much rather buy it at this point over here rather than this point over here. Whether you buy it over here or you buy it over here, in the long run, it doesn't really make a difference. Which is true if you see in the bigger perspective of things. However, what I believe some of these buy and hold investors overlook is the fact that during the short run, the prices of their investment and their capital might decrease 10%, 20%, or even 30%. I'm not saying one is better than the other or one is right and one is wrong. It really depends on the individual. And as an individual, like I mentioned earlier, I know that I'm not okay with my investments and capital declining by 10, 20, or even 30% in the short run. And that is why before I invest in stocks and buy stocks, one of the things that I take a look at is the risk to reward ratio. This allows me to invest in the stock market and in stocks with a good risk to reward ratio. And with a good risk to reward ratio in the stock market, one is more likely to invest at this point over here rather than at this point over here. If you have learned something from this video, smash that like button because it will really help the channel grow and allow this content to reach even more people and allow me to continue producing content such as this. And don't forget to subscribe to this channel because each week I release one new video about investing, trading, and the stock market. I'll see you in those other videos. To your financial success.